Good morning. This is Travis Bement with YourOrlandoMortgage.com, and this is my economic and mortgage commentary for the week of June 15th, 2009. Rates, where to from here? Before we get into this week's topics, I felt a little refresher was in order. We talk about where rates are headed, but it is important to know how rates are created in the first place. As we have learned over the past 2 years, mortgages are grouped together and sold as mortgage-backed securities. Based on the historical numbers and some other statistics, these securities are then priced to be sold on the open market. The interest rate and yields demanded by the buyers for these securities, based on market conditions, are what help to determine the rates that are charged on a given loan. For a barometer on pricing, we tend to use the 10-year Treasury note, amongst other indicators, to see which way the market is headed. In addition to that, there is a spread or a margin over index prices. These margins cover things like defaults, early payoffs, and risk-based issues. The margin or spread has increased in recent years as the mortgage and real estate market has suffered. With this refresher over, it's time to focus on this week's news. Rates have risen as much as 1.5% in just the last 3 weeks. But as expected, the markets came to their senses a little, and rates and pricing have eased somewhat. While inflation is still a very big issue, the general consensus is that for now, there was a little overreaction to inflation fears. Let this recent run up in rates serve as a warning for what is to come. Inflation will hit the mortgage pricing, and it will hit it hard. The constant spending and borrowing cycle of the government will bring pressure to all areas of borrowing. If an investor can buy debts covered by the full faith and credit of the United States government, they will be less apt to buy other forms of security. If they do choose to buy other securities, they will undoubtedly require higher rates to justify the increased risks. Once the cheap money goes away, borrowing of any sort will get more difficult. In addition, the current administration is asking for broad new powers to regulate the financial industry. While some of these powers are needed to ensure that we don't repeat our recent history, many of them will simply make business and lending more difficult and more expensive for everyone involved. As for rates, expect continued pressure as we wait for the next Federal Reserve meeting, which comes next week, and look for any signs for a change in policy. What does that mean? Well, let's look at the title of a movie I just took my kids to see. The title of the movie? Up. It's a good movie, but it's bad for rates. Thanks. We'll see you next week.